Okay, let's dive deep into Autodesk's first quarter fiscal year 2026 earnings call.
Right.
For experienced investors like you listening, our goal is really to distill the key results, the management commentary, and what they're seeing ahead.
Yeah, basically cut through the noise. And they reported a pretty strong start to fiscal 2026.
Absolutely. Exceeded expectations across the board, really.
Revenue and non-GAAP earnings per share both came in above the high end of their own guidance ranges.
Which is always good to see.
And it wasn't just those headlines. Billings, non-GAAP margins, free cash flow, they also beat.
Okay, so let's get those key numbers out there for everyone. Total revenue grew 15% as reported.
Yep, and 16% if you strip out currency effects, so constant currency.
Strong. Billings saw even more of a jump.
Yeah, up 29% reported, 30% constant currency. Big acceleration there.
And their RPO, the remaining performance obligations, that backlog figure,
hit $7.2 billion. That's up 21% year over year.
And the current portion of that, the next 12 months,
$4.6 billion, still a healthy 16% increase.
Non-GAAP operating margin expanded nicely too.
To 37%, yeah. That's a 3 percentage point improvement from last year. Shows good leverage.
And finally, free cash flow.
$556 million generated in the quarter. So yeah, pretty solid operational and financial performance to kick off their year.
Okay, so that's the snapshot. Good numbers. But let's unpack some of the drivers behind them. There are a few moving pieces here.
Definitely. A big one was that new transaction model they've been implementing.
Right. How much did that add in Q1?
It contributed about $78 million to revenue and $105 million to billings.
Okay, so important context. But what's, really key for investors is looking beyond that specific impact.
Exactly. If you exclude the new transaction model and you look at constant currency again, total revenue still grew a healthy 11%.
And billings?
Still up 22%.
So that 11% adjusted revenue growth is solid and 22% adjusted billings. Well, that indicates the underlying demand momentum is still there, similar to recent quarters.
Right. And they specifically called out strength in AECO, architecture, engineering, construction, operations, plus good upfront revenue from enterprise business agreements, EBAs.
And the Autodesk Store seems to be performing well too.
Yeah, and it sounds like the friction, the bumps in the road from implementing that new transaction model are starting to ease up.
Which is good news for the future, obviously.
Definitely.
Okay, let's shift gears slightly to profitability. The GAAP operating margins actually decreased by 7 percentage points.
Yeah, that might look concerning at first glance.
But the call clarified it was mostly driven by two specific sort of one-off items.
Pretty much a $15 million restructuring charge, which happens sometimes.
And a bigger one, a $54 million one-time non-cash adjustment related to stock-based compensation for the employee stock purchase plan, the ESPP.
And the key thing there, as they stressed, is that this specific ESPP adjustment is just for this period. It doesn't change the expected path for stock-based comp going forward.
They still want to bring that below 10% of revenue over time.
Right. So when you filter that noise out and look at the non-GAAP operating margins,
you see the underlying strength, that 3 percentage point increase we mentioned earlier.
Exactly. It reflects real operating leverage. They're disciplined on costs, got some timing benefits from the restructuring.
Although the new transaction model does have a slight drag on margins, right?
It does, yeah. So that partly offsets some of the gains.
Right.
But overall, strong non-GAAP performance.
Okay. Capital allocation. What are they doing with the cash?
Well, continuing to invest organically, prioritizing strategic stuff like the cloud platform and AI development.
Standard practice. But they also did more share buybacks this quarter.
Significantly more, actually. Bought back 1.3 million shares for about $353 million.
What was the average price? Around $269.
Yeah, roughly $269 per share. And they signaled pretty clearly that they plan to allocate more capital to buybacks going forward.
And that makes sense, right? The free cash flow is rebuilding now that the big multi-year transition to annual billing is mostly done.
Exactly.
Yeah.
More free cash means more capacity for shareholder returns.
Right.
Buybacks seem to be the preferred route.
Okay, let's talk guidance. Always a huge focus. Fiscal 2026 Outlook update.
Right. And to make things clearer, they gave the guidance ranges excluding the impact of that new transaction model and in constant currency, trying to show the underlying business dynamics.
So the adjusted guidance ranges, it's a bit of a mixed bag influencing them.
Yeah. On one hand, they're getting a bit of a tailwind from foreign exchange. The U.S. dollar depreciating helps.
But offsetting that
Is what they called increased caution. They're factoring in more macroeconomic uncertainty than before.
Okay, and this prudence, as they termed it, is really important for you to understand.
Definitely. Because the lower ends of their new billings and free cash flow guidance ranges actually assume things get tougher.
Like new business growth slowing down to pandemic-era rates.
Yeah, and also assuming that the uplift rates they get on EBA renewals deteriorate.
But crucially, they haven't actually seen this happen yet in the business.
Correct. They're building in a buffer for potential headwinds, being conservative in the outlook.
Which makes sense in this environment. But their underlying revenue growth guidance, that stayed the same.
Right, because subscription revenue is more ratable, less volatile quarter to quarter.
So putting it all together, the updated guidance ranges for fiscal 26 are now billings,
$7.16 billion to $7.31 billion.
revenue,
Guided between $6.92 billion and $6.99 billion.
and free cash flow.
Projected between $2.1 billion and $2.2 billion.
And they also bumped up the bottom end of the non-GAAP operating margin guidance.
Reflecting that operating leverage and cost discipline we talked about.
Makes sense. GAAP EPS guidance reflects those Q1 charges naturally.
But non-GAAP EPS guidance was increased, which lines up with a higher non-GAAP operating margin forecast.
Okay, so, in a world feeling pretty uncertain right now, management tried to give investors a few anchors. 3 areas where they see certainty for Autodesk.
Yeah, what do they highlight?
First, they really believe this new transaction model is the right move. It's proactive, positions them to integrate better with customers, automate more with partners.
And ultimately opens up new growth and margin opportunities down the line.
Second anchor, that rebuilding free cash flow stack we mentioned, it just gives them more capacity for sustainable shareholder returns.
Specifically calling out share repurchases again.
Yep. And third, they argue that as they get near the end of these 2 big business model transitions, first the shift to subscription, then the move to annual billing.
Autodesk just becomes, easier to analyze, less complex for investors to understand and value.
Right. Those are the stability points they want you focused on.
Okay, let's dig into the strategic growth initiatives then. What's actually driving the business forward?
The core focus hasn't really changed. It's that convergence of design and making happening in the cloud.
Enabled by their platform strategy, their industry clouds, and increasingly, AI.
And they gave some pretty good customer examples from Q1 showing this is gaining traction, in AECO, for instance.
Yeah.
They highlighted closing their second largest EBA ever with a major infrastructure firm.
Wow.
And it wasn't just about selling licenses. It was strategic focused on accelerating BIM adoption, getting everyone onto Autodesk Construction Cloud, ACC, as the common data environment.
Using data better across the whole project lifecycle. That's the goal.
Exactly. We also heard about Hitachi Energy expanding its use of ACC, Revit, and Fusion in an EBA renewal. They're focused on digital twin solutions for things like predictive maintenance.
So these are deep integrated partnerships, not just transactional sales.
Definitely. And another one, a leading design build general contractor standardized on ACC. Why? To unify project data, workflows across design, engineering, subcontractors.
Basically trying to manage increasing project complexity and just get everyone collaborating better.
The common thread you see in all these HECO wins is this need to connect everything people, processes, data across the whole project.
It's about efficiency, sustainability, reducing risk, this big push for digital transformation in construction and infrastructure. It's a huge tailwind for Autodesk.
No doubt. And you see similar themes on the manufacturing side. Customers investing in digital transformation, consolidated onto Autodesk's platform.
Like who?
They mentioned Waldner, a German industrial group, moving from 2D to 3D, using the Product Design and Manufacturing Collection and Vault Pro to streamline things.
Okay.
George P. Johnson, they create brand experiences consolidating multiple old systems onto Fusion Manage and Fusion operations for their fabrication facilities.
Trying to automate workflows, break down silos, get better planning visibility. Makes sense.
And Grain Handler, an agricultural equipment maker, actually replacing competitor tools with Fusion for a unified design and manufacturing workflow.
That's interesting. Shows Fusion's growing capability for more complex manufacturing needs, right? Not just design.
Exactly. And these manufacturing examples show Fusion driving strong ACV growth. They specifically noted increasing attach rates for extensions.
Meaning customers aren't just buying the basic Fusion product, they're adding these valuable modules.
Which increases the deal size, makes them stickier, and drives up the average sales price. It's a good dynamic.
And what about AI? Everyone's talking about AI.
They are definitely translating their AI strategy into real productivity gains for customers now, not just
Like the auto constraint feature in Fusion.
Yeah. It uses AI to automate a really fundamental but tedious sketching task in 3D modeling. They said it's already helped create over 500,000 constraints since launch.
Wow. And user acceptance is over 50%.
That's what they said, which really shows their AI philosophy in action. Focus on specific high-value enhancements that automate repetitive stuff.
Freeing up engineers and designers for more creative, complex work.
Right, future opportunities they mentioned. Making Fusion the most AI-powered mechanical design tool out there. Enhancing AI in Forma for AEC tasks.
So building on what they have.
Yeah, and long-term, they think AI could make sophisticated 3D modeling easier, more accessible.
Potentially accelerating market share gains.
And maybe even enabling some price increases down the road as customers see the clear productivity value.
Interesting. Okay, what about the macro picture? The broader economy and labor issues.
They acknowledge that, yeah, customer conversations do flag uncertainty, trade worries, policy changes, material costs.
But the focus of those worries seems to be more on the second half of the year, not impacting current demand too much.
That's the sense they gave. The actual indicators they track now remain positive. Construction backlog is up, monthly active users are increasing, bid activity is growing.
So the underlying business environment for their customers seems reasonably solid for the time being, despite all the headline noise.
And interestingly, those persistent labor shortages we hear about everywhere, especially in industries like AEC, they actually see that as a positive driver for their business.
How so?
Well, with fewer workers available, these industries have to find ways to become more efficient.
Which forces them to look to technology for productivity gains.
Exactly. Driving demand for Autodesk's digital solutions. It's a counterintuitive positive in a way.
Okay, channel dynamics. How are things looking with their partners?
They're being pretty deliberate about encouraging consolidation. They want fewer but more sophisticated partners.
Partners who can offer real solutions. Maybe develop their own IP on top of the Autodesk platform.
That's the idea, and they are seeing it happen. Larger partners buying smaller ones, some lower tier transactional partners just kind of fading away.
And this is intentional. They think it will increase overall channel productivity and focus.
They saw some benefits in Q1 already, like robust activity on the Autodesk Store helped with price realization.
By capturing that down market business that might have gone through less strategic partners before.
Right. They expect channel productivity to keep improving.
Is there a risk there with fewer, bigger partners?
Potentially. You need to make sure those big partners stay focused on driving new business, not just managing renewals and collecting commissions easily.
So commission structures become really important.
Absolutely. Management said they address that through careful design there.
Okay. And go-to-market optimization, the new chief revenue officer.
Yeah.
Any disruption there?
They said they're not seeing the same level of disruption from channel productivity issues that hit them last year.
So the systems and process kinks related to onboarding customers onto the new model are mostly ironed out.
Seems like it. And the new CRO, who came from Microsoft.
Brings strong enterprise sales and cloud knowledge, right?
Yeah, which they see as crucial for this next phase, building deeper, more strategic partnerships with large customers.
And any disruption from the restructuring earlier sounds like it was managed and offset by momentum elsewhere.
Like the store and that upfront EBA revenue.
Yeah. So key things to watch going forward with this transaction model transition.
Definitely the first big renewal cohorts that's coming up in the Americas in June and then EMEA in September. Those will be important tests.
Got it. And on EBA trends specifically, upfront revenue helped Q1, but wasn't the only driver.
Right. They characterize it as one of several factors, not like an outsized thing. And importantly, the momentum they've seen in EBA renewals and the uplift rates they get, that's continued so far.
So the prudence in the guidance is really just a buffer in case that deteriorates.
Exactly. They haven't actually observed that deterioration yet.
Okay. One last point. Pricing philosophy. They talked about that group of customers who came over from maintenance plans years ago.
Yes, the maintenance to subscription or MTS cohort. They had like 10-year visibility on price increases.
Right, and that program is ending soon, sunsetting.
So what happens next for their pricing?
Well, they said it's too early for specifics, but any future price increases for that group will be consistent with the value delivered.
Which sounds like potential for future price hikes as those customers get more integrated with the platform, use new features like AI.
That's certainly the implication. Value-based pricing.
Okay. This brings us to that part of the conversation. where we brainstorm a plausible, maybe slightly outrageous trade idea based on everything we just discussed.
And let's stress again, this is purely for discussion, definitely not financial advice. Do your own homework.
Absolutely. But given the strong Q1 beat, the raised full-year guidance, even with that explicit caution baked in and the clear execution on strategy, cloud, platform, AI, driving real productivity.
You could argue the market might be a bit too focused on the general macro worries.
And maybe underestimating the actual impact of these specific Autodesk levers.
Right. Think about those tangible examples. The AI auto constraint feature already creating 500,000 constraints.
Customers standardizing entire massive infrastructure projects on ACC.
Manufacturing firms consolidating workflows onto Fusion, boosting ACV with those extensions.
The channel strategy deliberately aiming for better price realization. These aren't just future promises, right? They're happening now.
Showing up in customer wins, usage stats.
So the trade idea, the thought experiment, long ADSK.
The thesis being?
The thesis is that these demonstrated AI productivity gains, the platform consolidation power, the optimized channel, they're accelerating market share capture and enabling faster than expected margin expansion.
Because customers are recognizing the real efficiency value being delivered.
Exactly. So this narrative suggests that the actual business momentum from these company-specific factors could outweigh those potential macro headwinds.
The ones currently factored conservatively into the low end of the guidance.
Leading to potential upside surprises that maybe the market isn't fully pricing in right now.
It's basically a bet on specific operational execution and tech impact trumping generalized macro fear.
A fear that hasn't actually shown up significantly in Autodesk's own numbers yet.
Again, just one perspective, not advice.
Definitely not advice. Okay, let's sum up this deep dive. Autodesk put up a strong first quarter.
Yep, beat expectations, raised the full year guidance, even while building in some prudence for macro uncertainty.
And they seem to be executing well on those core strategic priorities: cloud, platform, AI.
The underlying business momentum looks pretty resilient, driven by that fundamental need for digital efficiency in their core industries.
And Autodesk's focus on delivering real demonstrable value through their tech and optimizing how they sell it.
It's definitely a fascinating situation for you to consider.
Yeah.
That contrast between the current strength they're seeing
versus the forward guidance that proactively assumes things might get tougher, even though they haven't seen it yet.
And then you layer on top of that the long-term potential from their big bets, like AI and platform consolidation. Lots to think about.
As always, this information is just for informational purposes based on our review of the earnings call. It is absolutely not financial advice.
Please do your own thorough research. Consider all the factors relevant to your own situation before making any investment decisions.
Thanks for joining us for this deep dive into Autodesk's Q1.